Welcome to Trading Nation. I'm Mike Santoli. Stocks falling after the Fed hiked rates by a quarter point and lowered its forecast for rate hikes for 2019, but maybe not enough. Joined now by market researcher Jim Bianco. Bianco Research, who's been critical of the Fed's policy to date. So, Jim, good to have you here to react to this. So, obviously, the market didn't love what it heard. What did you hear?
Yeah, more of the same. The market was pricing in less than one rate hike for next year. We already assumed they were going to raise rates today. The economist average was at 2 rate hikes. The Fed in September was at 3. They came down from 3 to 2. So it was not dovish enough for the market on the initial reaction. They were expecting them a little bit more, and now the market's worried that 2 rate hikes next year might be too many.
Yeah, I mean, I guess on one level you say, okay, they're down to, at least on paper, 2 rate hikes for 2019. There are 8 meetings at which they'll have a press conference and could be live for some decision. So 2 out of 8, I mean, you could take most of the year off and still not stray from that policy. Do you think the market just needed that much more reassurance that they were on hold for a while?
Yes, I do, because what I believe Chairman Powell will tell us is that what's driving this pullback, this dovish move down to less rate hikes, is expectations for inflation have fallen. And the biggest driver of that has been the 40% decline in crude oil prices. If crude oil prices rebound in the first half of next year, expectations for inflation will rise because crude oil is such a big part of it. Is crude oil driving Fed policy? Are they only pulling back because crude oil prices are down, and if we get an inevitable rise, there will be more than 2 rate hikes? That's why I think the market wanted to hear something more than just a reaction to crude oil prices.
Now, aside from the market expectations and the contrast with what it wanted and what it has gotten now, do you think the economy in itself merits this position by the Fed to say, look, we at least think we can get 2 more in next year?
The U.S. economy, no. I don't think that there's really solid evidence of it, but the world economy, yes. If you look at Europe, you look at Asia, you look at the emerging markets, there is definite signs of them slowing. 40% of S&P 500 revenues come from overseas. If the rest of the world is slowing down, the bet is that it will eventually hit us.
Mm-hmm. And I guess the initial reaction in terms of the bond market was yields coming in, right, coming down a bit. So what's that? What is that verdict by the bond market, at least initially, essentially kind of flattening up the curve again?
Yes, the yield curve is flattening because long-term interest rates are falling faster than short-term interest rates. Yeah. And this is what bond people call a bull flattener. And typically bull flatteners occur because of a perception that the economy is slowing or will slow.
Right. All right. Well, still remains a fair bit of space between the markets and the Fed. We'll see what happens as things go on from here. Jim, thanks a lot for joining us today. Appreciate it. And thank you for watching Trading Nation. I'm Mike Santoli. We'll see you next time.